Well, let's get chatting with our market expert now. Prakash Diwan joins us on the show. Hi, Prakash. Good morning. Hope you had a good weekend. Well, let's start off by talking about Polycab itself. I'm looking at their numbers, very, very good. Highest ever quarterly profit is what they delivered. In the cables and wires business, they've gone ahead and got a higher chunk in terms of market share. I think it's increased by around 200 basis points odd. The stock is not very, very cheap. But with these sort of numbers, does it demand these elevated valuations of around 35 times odd?
Good morning, Nigel. Thank you. I think, this kind of a performance was largely anticipated given what had happened in the Jan-Feb March quarter from, some of the regulatory action that took place. The revenue recognition norms would have changed. Things would have been slightly more positively disposed towards, the P&L getting strengthened. But, whether these margins are sustainable, that is a big question. And to answer that, I can tell you the capex that they are looking at undertaking will actually move them into the leadership. I mean, make their position in the leadership market segment very strong. So, that's where they probably have a right to win. But I don't see any reason why the valuations would probably soften so much, because it's leading the wires and cables back so dominantly that if you see on the ground in terms of the distribution network and all, it's fairly well acclaimed, well accepted. And I think the product range needs to kind of, the FMEG is suffering because I haven't seen any innovative launches, any disruptive thought process behind that. But probably, as the CFO was indicating, they probably are re-looking at some parts on the distribution side. So if that happens, you'll probably have another engine on which it starts revving up. But I would expect the higher valuations to sustain. I know it's a question. You would end up buying it on dips to make sense, because you will get these dips in the volatility that we are seeing. And then it probably makes sense. Your risk reward starts getting better. But the trajectory seems to be very strong going forward.
Prakash, hi, good morning. I think you know what my next question is going to be on Tata Motors, because, the numbers were not bad, but the commentary was a bit cautious, right? They expect EBIT margins to be flat in FY25 for Jaguar Land Rover, so no growth there. But how do you see the stock move today?
Good morning, Sonia. So, very interesting set of numbers, because, certainly it's only when you come to the guidance that you realize that there's something which you need to be cautious about. But otherwise, it made you believe that they are firing on all cylinders, JLR, domestic PVs, and of course, the CV cycle, which probably is some time away. But if you look at Ashok Leyland's performance, there's no reason why their CV business will not pick up as well. Interestingly, what the management seems to be doing, and this is my view from anecdotally tracking the con calls and reactions thereof, they're trying to manage expectations and build in some sort of a caution that things could not be as robust as what's happened last year. I mean, it's been a stellar FY24, but whether FY25 can replicate that is a big question. The answer is not necessarily, and that's exactly why they're trying to manage that. But I would buy it on dips because there's no reason why suddenly things will start getting very different, Sonia. In fact, the raw material price pressure that he spoke about, I don't think that's such an immediate thing that you need to worry about. So, the likes of Eicher and all are actually gaining out because of the softness in RM prices. There's no reason why this. And the big triggers will be deleveraging to continue and to come to some conclusion, which I was expecting would be announced, but hasn't had timelines come through. But you will see the segregation of the CV and the PV business becoming a big trigger going forward. So I would be positive. Don't write it off so easily just on the basis of a broad softness in expectations.
Prakash, hi, morning. Did you look at the Bank of Baroda numbers? I mean, the stock sold off, actually, there was a 5% cut, ended, I think, about 3.5 lower. But generally, numbers seem quite okay.
Good morning, Prashant. So this is, if you look at what happens, it's a question of, anecdotally, it's about timing at times. SBI came up with numbers which were so stellar. And when Bank of Baroda, which is the second best in that class, stands up and starts showing its earnings, you start sensing that there is a little bit of a disappointment because there's an immediate comparison. If you go back 3-4 days and you see Canara Bank numbers, they were so interesting. The kind of expectation management that there you see the management on its call doing is again trying to make people believe that things are going to be not as great as what's being penciled in from the price perspective. But a NIM of 3.5%, 3.4%, kind of write-backs that they're taking 6,000 crores every year. I don't see any reason why these banks would have to be looked at with any softness in the price-to-book multiples. And from Bank of Baroda's perspective, I can tell you that there's a lot of positives that would start showing up in the next few quarters now that the RBI clearance has been given to them. But how quickly they can take advantage of that is a big question. So I've always had some issues with Bank of Baroda in terms of execution, but Canara Bank stands out as probably the best in class out there after SBI. So I would rather look at something which is far more promising with certain triggers packed in.
Prakash, I mean, of course, with politics, we'll know when we know, which is, of course, going to be the first week of June. But Mitesh was earlier telling us about, one of his trades was from the FMCG space. Now, that is the sector, or stocks from that space did between 4 to 6%. HUL, Marico, Dabur, Nestle. I mean, that looked like it was coming back into some sort of momentum. Any thoughts there briefly, and if you have a pick, something you like?
No, absolutely. I'm glad you brought this up, Prashant, because, when we were anticipating numbers to come through last week and Dabur was the one that I was very closely watching, because this thing is, it has a significant rural exposure and it has a little bit of a crossover on the staple side as well. So, if you look at those numbers, my sense is that the bottoming out phase is over in terms of demand. So whatever demand slowdown that we saw is probably now past us. And the HUL numbers also tell you that whatever volume degrowth that we've seen is probably not something which you could kind of anticipate any continuation in. Now, whether this you need to wait for the monsoon to kind of start triggering a demand revival or not, that's the big question. But the anticipation of a good monsoon will probably start kind of getting priced into these stocks. The other stock that I'm watching very carefully is ITC, for the simple reason that within the FMCG pack, there is nothing else which is better poised in terms of resilience. It has a tobacco business. Now it also has a hotel business kind of shaping up for the demerger. And then, of course, the fast-moving consumer goods segment also is kind of doing fairly well. So it's a stock that's got ignored. Someday somebody will start getting interested at 430, 435 and start looking at the kind of promise that it holds. So I don't see any reason why these stocks will not come back. And the flight to safety in the volatile times that we are seeing will probably make it even better for these names. But Dabur and ITC absolutely stand up.